You have an idea for a small burger shop, but turning that idea into a big restaurant chain needs millions of dollars. You can't do it alone, so instead of borrowing money from a bank, you invite thousands of people to become your business partners, and that simple idea is basically how the stock market works. What is a stock? A stock is simply a small piece of ownership in a company. Think of a company like a huge pizza. If the pizza is cut into 100 slices and you buy one slice, you now own 1% of that pizza. In the business world, those slices are called shares, and anyone who owns shares becomes a shareholder. That means you now own a tiny part of that company. Why companies sell shares? Let's say James wants to launch a tech startup called SmartCup, a coffee mug that keeps your drink hot for hours. He calculates that building the factory, marketing the product, and hiring employees will cost $1 million. But James only has $200,000. Instead of stopping the idea, James decides to sell ownership of his company. So he divides the company into 100,000 shares and sells them to investors. People who believe the idea will succeed buy those shares. The money they invest helps the company grow faster, and in return, those investors now own part of the company. Where stocks are bought and sold? But where do these shares actually get traded? That's where the stock exchange comes in. A stock exchange is basically a global marketplace for company ownership. Just like people buy and sell products on Amazon, investors buy and sell company shares on stock exchanges like New York Stock Exchange, NASDAQ, London Stock Exchange. Today, these markets are mostly digital, meaning millions of trades happen every second through computers. How stock prices go up and down. Now here's where things get interesting. Stock prices change constantly because of supply and demand. Let's go back to our SmartCup example. If the product becomes extremely popular and millions of people start buying it, investors will believe the company will make huge profits. So more people want to buy its shares. When demand increases, the stock price rises. But if something goes wrong, maybe the product fails or a competitor releases something better, investors might panic and start selling their shares. More sellers and fewer buyers cause the stock price to drop, so the stock market moves like a seesaw, going up and down based on expectations about the future. How investors make money. Investors usually earn money in two main ways. First is price growth. If you buy a stock for $20 and later sell it for $40, you've made a $20 profit per share. The second way is through dividends. Some companies share part of their profits with shareholders as regular payments, so investors earn money just for owning the stock. The risk of the stock market? But the stock market isn't a guaranteed money machine. Companies can fail, markets can crash, and prices can change within seconds. Sometimes even a rumor or news headline can move billions of dollars in the market. That's why many experts suggest long-term investing instead of trying to get rich quickly. Why the stock market exists. At its core, the stock market does something very powerful. It connects people with ideas to people with money. Investors help businesses grow. Businesses create jobs and new products. And everyone shares in the success. That's why the stock market has become one of the most important financial systems in the world. Ending. So the next time you hear about stocks going up or down, remember, you're not just watching numbers move on a screen. You're watching millions of people investing in the future of businesses, and that's how the stock market really works.